Hi, I'm Jim O'Connor. I'm one of the tax shareholders with Rivero, Gordimer Co. Welcome to another edition of Beyond the Bottom Line. I'm here with Chris Terrigino. He's one of the audit shareholders with the firm. We wanted to have a chat about accounting for internal use software. Chris, I know this is an area you spend a lot of time in. What are some key takeaways here?
Well, it's a very interesting area, as a lot of companies are starting to develop a lot of their own internal use software. And that is one of the first key areas to look at. This applies to internal use only. What we're talking about today does not apply to software that you are going to be selling to customers or other parties. Internal use is software that's developed or purchased basically for the use of that organization only. And the rules around this are following the accounting codification section 350-40. This is internal use software which falls under the intangible rules. Now, when you look at that internal use software, what is that exactly? That's going to be software that we develop for our use. It could be our accounting system, that we coded into that. It could be software that you use for your production lines, that you're developing to run those production lines and build the products you're using. It could be software related to the interface you have with your customers, such as some of the website costs. Also, it could be for cost-related software to help provide services to your customers. And looking at then what does this really mean, we're looking at these costs and saying, hey, should some of these be capitalized for long-term purposes? Basically, they benefit more than the immediate term. They benefit future periods. Or should some of these costs that we have be expensed today in the period they were incurred? So generally, in analyzing this, we are going to look at the 4 stages of the development here. First is a preliminary product stage. This is a stage where the company is generally thinking about what they want to do. They're looking at the need they want to fill with the software, or they might not know they need software for it yet, but those are some of the preliminary costs. And during this stage, the expenses are going to be expensed in that period. Now, the next stage relates to the application development stage. This is the stage where you are actively developing this product. Now, it could be from the ground up, where we create the software from scratch, or maybe I buy an existing product and we're modifying it to meet our needs. There could be costs related to that. A lot of costs in this time period relate to generally payroll costs, again, the cost of the software itself, maybe some outsourcing costs to help you with some of the coding features of this. Now, those types of costs right there would be capitalized because they are looking at benefiting a future period as you use this software. One note, though, is that overhead type costs, administrative costs, would not be part of the capitalized costs. You would not include those. Those would still be expensed as incurred. Now, the next stage of this development cycle is going to be the post-implementation stage. This is when the software is basically being implemented, it's in use and running. Any costs tied to this, that standard operation, are just that. Their costs are expensed when incurred. And then the 4th stage is what we call the upgrade or enhancement stage. This is where changes might be made to that software, initial software, adding new features, adding different types of features to it. This stage is looked at very similar to the 2nd stage, the application development stage, in that those costs that are enhancing or adding features would be capitalized. You look at it very much the same way. So now that we got that part of it, we looked at the cost of it. We say, oh, there's cost to capitalize, there's cost to be expensed in the period. What do we do? How do we do this? How do we amortize it? Well, when you look at these types of costs, there's many things to consider with the amortization of the capitalized portion. Okay, so generally these types of capitalized products, they're not considered to have a very long useful life. Generally looking at a very short useful life. Could be 1 to 2 years, trying to justify why that might be longer. Oftentimes when you look at technology such as this, there's obsolescence, there's feature changes that make old features obsolete, there's new technology. You might abandon the program you developed because you're moving on to a better product made by somebody else, off-the-shelf type product. So there's a lot to consider when you look at the useful life on this. And again, it's generally going to be a short time period. But Jim, I'm actually interested, what are some of the tax treatments for these types of?
Yeah, so right now we've got a lot of flexibility for tax purposes when it comes to software development costs. You can basically deduct as you go, as you incur the expense, just flat out deduct it, which is nice. You also have the option to capitalize it to sort of mirror what you're doing for book purposes and to amortize it over 3 or 5 years. But there's a big change coming beginning in 2022. It's just a few months away. You're basically going to be required to start capitalizing to mirror the book treatment, and you get to amortize it now over 5 years if that development was incurred in the U.S., and then 15 years if that development was incurred outside the U.S. So it's really important on where that software development is being done, to whether you get 5-year or 15-year. And just think another question I get, Chris. I'm a tax guy, but I get questions from my clients. Book purposes, how does this affect my EBITDA? I might be a software or tech company. I'm very concerned about my EBITDA. It's going to influence my potential purchase price sale. So when I get that question, what's my answer?
Well, okay. Generally, when you capitalize something, that's the A piece of the EBITDA, amortization. To capitalize the software costs, you're going to amortize them away. So in the initial year, generally, if you start developing this product, I start capitalizing those costs, that expense will not hit the P&L yet. So I'm going to defer those charges to a future period. Say it's 1 year, 2 years in development. Again, there's a lot of costs, a lot of payroll costs, travel costs, and other costs related to developing that software that are not going to be expensed yet. Now, once you hit that stage, the implementation stage where it's up and running, you start amortizing those costs over the period you determined. Whatever you figure the useful life is for book purposes, that's where it would flow through into the EBITDA, the amortization part of the EBITDA. So initially you can say this is going to be a plus. It's going to improve your EBITDA. As you go along, let's start amortizing it depending on how much of this type of activity you're doing. It might level out where now you're not going to see a significant improvement. But what will happen though too is you can look at it when we are done completely with any kind of development, we still might have amortization expense hitting where, before if you expected immediately, we may have been in a different period where that expense was. So generally this is going to, simply it's going to help your EBITDA.
Yeah. All right. Well, thanks for watching. If you like the video, please like and subscribe. We'll have more content on our website shortly. Thank you.
Thank you.